Man, it's been a crazy week this week in the oil markets. This week alone, WTI is down $7, and that's just happened in the last 2 days, too. But if you think that Trump's tariffs are the only thing driving the market, you would be wrong. Stick with me, keep watching this video, and I'll explain it all to you this week in oil. Hey, I'm Aaron from the Oil Balance. Follow me to elevate your understanding of the oil market. And for more information and to leverage our 50 years of combined oil market experience, go to our website, theoilbalance.com. All right, let's kick it off here. Instead of starting with the news this week, let's just get right into the price charts because this week has been crazy. As you can see on this weekly WTI chart, we've got a $7 range on the week. We've busted clearly below the support line I had in there before. We're bringing back support lines that go all the way back into the middle of 2021. A lot of congestion around this point in early 2021. But we've done some serious damage to these oil charts this week. If we look at the gasoline crack, so this is RBOB versus crude oil, you can see that RBOB's actually been weaker. It's had a bigger down move on the week than WTI has. But what's interesting is diesel fuel is actually up relative to crude on the week. So in other words, yes, diesel prices came down, but not quite as fast as WTI or crude oil futures did. So I think that's something interesting to tuck away in the back of your mind as you think about the rest of this video here. But let's go ahead and get into the headlines. So again, obviously the big thing this week was Trump's tariff. This is the first week in April. So on April 2nd, Trump announced that he'd have a whole bunch of reciprocal tariffs on different countries. So not necessarily just talking about the oil market, but just about any sort of good that you would import into the country. He was putting reciprocal tariffs on countries that tariffed our goods. So you can already see in the headlines there's some countries that are trying to work pretty quickly to work with the president to try to bring down the tariffs that they have on us and to try to get to more of a fair trade agreement. We'll see how that goes. I think China's already pushing back, saying they're going to increase tariffs on American goods. So you got some good news, some bad news on this. Of course, the Port of Long Beach, this isn't really new news, but the Port of Long Beach already saw a big slowdown in February on the number of containers that they were handling, both inbound and outbound, or if you combine those numbers, it looks pretty big. I'll show you a chart here in a minute. But I think the big surprise, and maybe people who aren't super involved in the oil market maybe missed, is this OPEC surprise. So on April 3rd, which is yesterday as we're recording this now, they put out this press release saying that they're going to fast forward the ramp up of production. So if you remember back in March, well, let's go back even further. Back in December, they agreed that they'd start figuring out how to bring back 2.2 million barrels per day of oil that OPEC had previously taken off the market. When the March meeting came around, they said, yeah, we're definitely going to start bringing this back in April, but it's, somewhat voluntary. It's really dependent on market conditions, all this kind of thing. But yesterday, April 3rd, apparently they had a meeting, a virtual meeting of the 8 OPEC plus countries. And what they decided is that things actually look pretty good to them in the oil markets, and they were going to actually ramp up production. So instead of just going to the, if you remember a table that I sent out before, if you're interested, please ask in the comments or send me an email through our website, theoilbalance.com. I'll be happy to send you this information. But previously, OPEC had submitted sort of a calibrated increase of production to bring back that 2.2 million barrels per day. It averaged around 137,000 barrels per day, month over month, right? So they just steadily bring that back on. I made comments in the past that didn't make too much sense, that we have this, we have the seasonality in the market where there's more demand in the middle of the summertime. And if they really wanted to, that's when they should try to bring back extra barrels and then maybe reconsider in the fall and in the spring to maybe bring barrels off the market when there's a lot of refinery maintenance going on and that sort of thing. But what they said yesterday on April 3rd is they're going to skip ahead. Instead of just ramping up to the normal May levels that they gave us previously, they're going to ramp all the way up to the July levels. So apparently They see things as going pretty well in the oil market. I have a little bit different view on that, but for whatever reason, they're bringing a lot more barrels back. So their headlines say that they're going to bring back 411,000 barrels per day. I'm coming up with 409. There must be some sort of rounding error in some of the numbers I'm using, but it's a pretty big jump. Secondly, what they said in that press release that they put out on April 3rd is that the countries that are overproducing need to come up with some sort of compensation plan that's front loaded. In other words, they got ahead of the market. They got ahead of where they were supposed to be in terms of production, and they're supposed to submit this plan for bringing production back in line to where it needs to be and making up for that sort of ramping up too soon in front of everyone else. So, again, April 15th is when that plan is due. It sounds like from the press release, OPEC will publish it that day. I don't know. We'll see what happens. But watch out for April 15th in terms of another big headline coming from OPEC that might turn this thing around a little bit. Just in terms of context, my sources that I look at for OPEC production, OPEC exports, actually had March exports down. So this, we've been talking about production. OPEC typically talks about production. I'm changing it a little bit to talk about exports now, just for a split second. The core members of OPEC, their exports were down about 400,000 barrels per day in the month of March versus February. So maybe there is a little bit of give and take in these numbers. They knew that they were coming down a little bit, maybe too much in March, and now they're trying to catch back up. Maybe that's where they're seeing the bullishness in the demand side of the market that they're trying to come back and fill, because they are starting from a low spot in March, at least versus February. Maybe that's what some of this is about. But keep in mind that the balances, especially like the publicly available balances you can get from the IEA and even from STIO, from the EIA, they looked pretty oversupplied for 2025. And we'd sort of been flagging this for quite a while, that 2025 looks sort of oversupplied, and we really need demand to step up into the breach to keep the market from just becoming oversupplied, like we were saying. So still in the headlines, we've got, the Russian-Ukraine potential peace deal. Again, it's not going terribly well just yet. It still seems like there's a bit of a land grab going on before both sides will really commit to ceasefires in very specific ways. Again, it seems like there's a ceasefire in place, or a ceasefire talked about, for energy infrastructure, that neither one would take out the other's energy infrastructure, which has been, big targets up till now. So we'll continue to see how that goes. As of this recording, it sounds like we're still increasing military presence around Iran. The U.S. is increasing military presence around Iran, still keeping pressure on them, still going after the Houthis. So that's sort of kind of a new front that's opened up in the last month or so, to go after the Houthis there and build up military around Iran. So we obviously need to be keeping a close eye on that. As I mentioned last week, Asian markets seem pretty lackluster. This is a headline this is a bullet point from last week, but I can sort of fill that out with new data this week, with some of the Chinese data coming out now. So Feb diesel sales down 13% versus year ago. Feb gasoline sales down 34%. Jet demand's actually doing okay. It's up 5% year on year. And then Bloomberg is showing their road congestion numbers for the month of March is down 6.3% year on year. So, as I've been saying in these videos that we've been putting out, if you look at places like the IEA, the International Energy Agency, that put out publicly available balances, all of the demand growth is coming from non-OECD Asia, by and large. China is the biggest country of non-OECD Asia, obviously, and if their demand is going down, if they can't get their gasoline, diesel, jet demand to increase, that's going to make it just that much harder on the rest of the globe to compensate for this already oversupplied market, at least on the crude oil side of things. Now, to be fair, the IEA and others like us are really looking at the petchem side of the market. So it's the light ends, the things that go into making plastics is where the growth is really going to come from. And these figures here for diesel and gasoline and jet don't necessarily figure into that. But again, as your economy is growing, as the Chinese economy is growing, as industry is expanding, you would expect stronger diesel, stronger gasoline sales. So a little bit of again, it gives us pause that you're not seeing really strong demand, at least on the transportation side of the Chinese market. What's a little more opaque and a little bit harder to see is the actual petchem demand, but that's where we come back again to the tariffs. That's where it's going to hurt places like China, Vietnam, these reciprocal tariffs that Trump has put on. So that is a bit of a headwind, and that is a big concern as far as the sort of future outlook of the U.S. oil market. So one thing to bring in mind, I mentioned earlier, the port of Long Beach container totals really dropping. Sometime next week we should get the updated numbers for March, and we'll see how those perform. But this is one of the bigger month-on-month drops that they've seen. They do revise their data, so maybe when the numbers come out for March next week, we'll get some revisions, and this will maybe not look quite so bad. But at least for the port of Long Beach, which I understand is the biggest port in the U.S. as far as traffic goes on, that's not a terribly good sign. And then secondly, this is a chart of distillate demand in the U.S. Most all of these numbers are the monthly numbers, which are the more reliable numbers. What I've done, though, is superimposed the average of the weeklies here for February and March, just the change. So this first dot for 2025 is the demand number that the DOE put out on the 31st, on Monday of this week, as being the demand number for January. And I've just kind of superimposed the month-on-month average change to sort of show you what would happen if those weekly numbers are correct. And they're probably pretty close. It's probably in the right ballpark. How those would show up on the monthly numbers when those come out later. So Jan to Feb down slightly. March versus Feb, it's a huge drop. And of course, 2020 had an absolutely major drop because of the lockdowns and stuff that started happening in the month of March. So it's not great that we're on pace for that. If we go back just really quick to the gasoline headlines I told you about, it looks like some of the Chinese data were back to sort of Feb and March 2020 type levels there as well. So not ideal. I really think these are some red flags in the market, especially if there's any bulls left in the market at this time. One thing that's interesting, though, is we've been talking about this now for a couple weeks, but tracking the preliminary import numbers of crude oil on the weekly data, just like everything else on the monthly data, they come back with probably better, more reliable data, but they do publish preliminary numbers of crude imports by country. So I've stripped out Canada and Mexico, as that's who we are tariffing at this point in terms of crude oil itself. Probably with the reciprocal tariffs, there'll be another layer of that. But at any rate, at the end of February, we got a fairly strong number. First 2 weeks of March, we got really low import numbers, and then those have totally bounced back to where, as the most recent number here at the end of March, is the 28th of March, is actually the largest we've seen to date, and not too far less than 100,000 barrels per day off the all-time high. So those barrels are coming back into the market. It's probably too soon. These numbers are as of the 28th of March, when crude oil was getting back above 70. But I guess the silver lining of the big sell-off that we've seen this week, if it sort of continues on for a little while, is that these tariffs are proportional, right? So it's 25%, 10% of the value of the crude. So in this instance, anyway, maybe that's the silver lining, is that as crude flat price comes down, the size of these tariffs shrink proportionally to that. And over the long run, versus the previous quarter, sort of thing, they don't feel that bad. They're not, best thing would be for the tariffs to be gone. But if we can't have that, then dropping the flat price of the market actually helps reduce the tariffs too. I still think this would probably be a good year to take a road trip. So again, we'll see what happens with the tariffs, but gasoline demand or gasoline inventories are higher than they have been in previous years. It's getting kind of close here in the Gulf Coast, but at least on the East Coast in Pad 1 and in Pad 2 in the Midwest, gasoline stocks are pretty high. Then looking at the retail price, we are getting a little bit of a seasonal increase, as I've been talking about. We're now transitioned into the summer spec, or at least the first part of the summer spec for gasoline. Everyone's quoting A2s now in the gasoline markets here in the Gulf Coast, and it's been that way for a week or two. A2s are harder to make, M2s are harder to make than the winter grade. It's just more expensive to do. There's fewer things you can add. The recipe kind of gets stripped down in the summertime. There's fewer things you can add because you're limited on your RVP essentially. So yeah, I think retail prices directionally probably still go up with a $7 per barrel sell off this week, and even bigger drop in the gas cracks and the RBOB versus TI cracks this week. Man, maybe you do get some cheaper gasoline coming in here. So again, that would be a good thing for early summer road trip. We'll see how that goes. On the RBOB versus ULSD or RBOB versus diesel curve, I added this week's curve in. So as of yesterday, the settlements as of April 3rd, we're back to the same situation we were a couple weeks ago, where gasoline is just at a discount. It's fairly close here in June, but it's at a discount to diesel for the entire rest of the forward curve, essentially. So the market, at least on the pricing side, the market's continuing to price diesel like it's tight because inventories are still low. Gasoline does look fairly loose. So again, probably a good year to take a road trip if that's, if you're able to, rather than to fly off somewhere and to take a foreign trip. Again, we'll see what happens with the tariffs and how friendly other countries are, but just kind of throwing it out there for you. And then here's our pad breakdown. I put these now at the end of every video so people sort of know what I'm talking about, where the different markets are. But if you like this video, if you like this content, please like and subscribe. And again, please go to our website, theoilbalance.com. There's a couple different ways on there you can get in touch with me, and we'd love to hear from you. So talk to you next week. Bye.